in collaboration with Fill the Gap. I'm Philip Williams, founder of Fill the Gap, a company that's focused on helping you to find and fill the gaps in your financial knowledge so that you can make the most of your hard-earned money. It's a pleasure to be your host today, where the focus will be on helping you as a new or potential investor understand how to do your own simple financial health check on some of the companies that you might be thinking about investing in. Just a bit about the CFA. The mission of the CFA Society of Trinidad and Tobago is to be the local embodiment of the CFA's Institute principles of ethics, education, and professional excellence, where investors' interests come first, markets function at their best, and economies grow. Before we go any further, CFA stands for Chartered Financial Analyst. It's a professional designation given by the CFA Institute to individuals who have passed a series of rigorous exams, and CFAs are recognized globally for their expertise in investment management and financial analysis. In very simple language, the CFA designation is the gold standard for investment management and financial statement analysis. Now, if you are new to investing, conducting financial analysis or financial statements analysis of a company can sound a bit daunting, especially, if you do a Google search and you bump into financial terms like income statements and balance sheets, profitability, liquidity, solvency, intrinsic value, and so on. Fortunately for you, our presenter today will break it down in very simple terms and make it a lot easier for you to understand. So it will be a good idea for you to take some notes, so make sure you have a pen and notepad ready. There'll also be a Q&A segment at the end for you to ask any questions. Just before I introduce our speaker, if you're just joining today's session, welcome to this Beginner's Guide to Investing webinar hosted by the CFA Society of Trinidad and Tobago in collaboration with Fill the Gap. You're just in time to hear our feature presenter. An alumnus of the University of the Southern Caribbean and the Arthur Luckjack Global School of Business, with degrees specializing in finance, both at the undergraduate and graduate levels. Presently, he's a lecturer at the University of the Southern Caribbean, and with 9 years of experience working in the financial industry, he currently holds a position of research manager in the investments department of the Trinidad and Tobago Unit Trust Corporation. Please give a warm welcome to CFA charter holder and a director of the CFA Society of Trinidad and Tobago, Mr. Andrew Maharaj.
Thanks very much for that introduction, Phil. So today, as Phil mentioned, we'll be going through some key ratios in terms of being able to analyze and assess a company that you may be interested in investing in, right? Before we start, though, I just want to make it clear that while we will be using actual figures of companies listed on the Trinidad and Tobago Stock Exchange, the point of this exercise really is for illustrative purposes to show you the practicality of what we'll be going through. It is by no means any endorsement or buy recommendation for any of the companies that we'll be looking into. So I just want to put that out there, that this is really for illustrative purposes and to show you how easy it can be to apply this in the real world. All right. So let me just share my screen with the presentation. Well, you can let me know if you're seeing.
Yes, I am. I'm seeing the screen. So it's in. Are you in slideshow? You're in presenter mode? Which okay.
Yeah. Great.
Perfect. I'm seeing it. Thanks.
So welcome everyone again. And today we'll be doing a financial health check on companies by using ratio analysis. But before we jump into the actual ratios, I just want to dial things back and start from the beginning. So where would you get this information to apply these ratio analysis so that you can make an informed decision? Well, the first point, or starting point, I should say, will be the key financial statements of companies, right? Now, the key financial statements are the income statement as well as the balance sheet. In terms of what they are and how they interact with each other, you simply need to think about, if you were to start a business, what are the logical steps? So when you're starting a business, of course, you need capital to begin with, right? And there are generally only two sources of capitals, or ways you can raise funds. One would be if you put up the money yourself, or you get it from investors. It could be friends, it could be family members, and that is known as equity or an ownership stake. So if you're taking funds from individuals in the form of equity, in exchange, you will have to give up part of your company in the form of an ownership stake. So that's the trade-off you get with respect to equity. On the other hand, another source of fund would be debt financing, right? And this is generally borrowings or loans. So typically, companies would approach a bank for this source of funding. So when starting a company, those are the two types of financing available. One, equity, and the other will be debt. So those two sources of funds primarily make up the right-hand side of the balance sheet, right? The sources of funds. Now, when you have your funds, the next thing you want to do is to put those funds to work to purchase the respective assets that you want to have for your business. So depending on the nature of the business, you would need to have inventory, right? You would need to purchase machinery, vehicles, land, and office space. So once you have acquired your sources of funds, you then need to put the funds to use to acquire assets, right? So that is essentially what the balance sheet is comprised of. The sources of funds will be on one side, right? And then what you use those funds to acquire will be on the other side. So that will be your assets. So on the balance sheet, we have assets, and then we have debt and equity on the other hand, right? And as the name suggests, the balance sheet, it must balance. Now, once you have acquired the sources of funds, you have purchased the respective assets for your company, the next thing you need to do is to start your operations, right? And that is where the income statement comes into play. So once you start operations, the whole point of going into business is, of course, to generate a profit. So the income statement highlights what you would have earned in form of sales or revenue. What were your expenses? Of course, you may need to hire employees, so you need to pay salaries. If you're renting an office space, you need to pay rent. So once you back out all the expenses from the revenues you would have raised, then that would give you your profit, right? So that is essentially what the income statement comprises: your revenue, all your expenses, and then at the bottom, you would usually have your net profit. Now, while financial statements do provide some color in terms of how a company is performing, what a challenge in analyzing the financial statements on its own is that we have companies that may be larger than others. So if we were to look, for example, on the income statement, and we see a company is making $1 billion in profits, a big company, right? And we are comparing that to a smaller company that's making, let's say, 100,000 in profit. It would be tempting to assume that the larger company is performing well simply because the raw figure is showing that's $1 billion. But that may not necessarily be the case, right? It could mean it's just because of the size. The smaller company may actually be better or more efficient in generating profits based on its available assets. So that is where ratios come into play, right? So ratios are just a tool that essentially levels the playing field, right? By taking size out of the equation so that you could fairly compare the performance of two companies, whether one is big and one is small, right? So ratios can generally be broken into four broad categories, right? Now, we will be spending some time in terms of the more popular ratios within each category. This is by no means an exhaustive list. There's several ratios within each category, but we'll be just focusing on one or two of the more popular ones within each category. So one of the major categories of financial ratios are profitability ratios. And these just simply tell us or gives us the idea of how well this company is able to deliver profits, right? Second category is liquidity. And these ratios tell us the story of how well the company can meet its short-term debt. We have solvency ratios, which speaks to the firm's ability to meet its long-term debt. And in finance, generally, the distinction between what is considered short-term and long-term is generally a year. So when we say the ability to meet short-term debt, we're talking about obligations that will become due within the next financial year for the firm, right? So that may be if the company, for example, took goods on credit and they have to pay the supplier within a year, that will be considered short-term debt, right? Whereas solvency is for more longer-term debt. So for example, if the company were to acquire an office and they had to apply for a mortgage, a 30-year mortgage, that would be an example of a long-term debt. So the distinction between liquidity and solvency really is in the time frame. So just to recap, liquidity has to do with short-term obligations, meaning any obligations of the firm within 1 year, while solvency has to do with the long-term debt or any obligations that are due beyond 1 year. And then the final category of ratios that we want to touch on are known as valuation multiples. So these essentially tell us, is the company undervalued, overvalued, or fairly valued, right? So when looking at the share price on the Trinidad and Tobago Stock Exchange, for example, these ratios will help us determine whether, this is a good buy with respect to value, right? So we want to jump in now to the profitability ratios, and the two main ratios that we want to touch on. One is the net profit margin, and the second is the return on equity. So the net profit margin simply tells us how the firm is able to deliver profits in relation to sales. So the formula is net profit divided by total revenue. And just for everyone's point to note that revenue and sales are the same thing, and that's usually found at the top of the income statement, right? And profit and income is usually synonymous with each other. So if you see somewhere it says net profit or another place you see net income, just know that it essentially means the same thing. So for the net profit margin, the formula is net profit over total revenue. So essentially, it's the number at the bottom of the income statement divided by the number at the top of the income statement. And what it essentially tells us is that for every dollar that the company generated in sales or revenue, how much is the company able to extract in net profit for us, right? So it shows how efficient the company is in terms of generating profit from the sales. And then the second one is return on equity. And this tells us the ability to deliver profits using shareholders' money. So as I mentioned before, in terms of the sources of funds, right? Shareholder investors who put money into the business to start. So the return on equity tells us for every dollar that an investor would have put into the company, how well is the company able to generate profits for that investor or shareholder, right? So the formula is net income or net profit divided by shareholders' equity, right? So now we're going to jump in some actual examples using companies on the Trinidad and Tobago Stock Exchange, right, to highlight how you would calculate this formula and how to interpret it. Now, what we're seeing here are some examples of companies in the banking sector locally, right? So we have First Citizens Group, First Caribbean International Bank, NCB Financial Group, so that's equivalent to like the Republic Bank of Jamaica. We have Republic Bank as well as Scotia Bank, right? Now, one thing to note with respect to ratios generally is that it is advisable when you want to compare companies that you usually compare companies within the same industry. And that is because the dynamics of a particular industry may be unique. So it would not make sense, for example, if we wanted to compare First Citizens Group with, let's say, Massey Holdings, because they're in completely two different industries. It will kind of skew the results in terms of the interpretation. So it's generally advisable that when you want to do an analysis of a particular company and you want to compare it to others to know whether it's relatively better or worse, it's advisable that you want to keep it within the same industry. So in this example, we're using the banking sector and we're looking at the net profit margin. So you can see here we have listed the revenues for each of the banks as well as its net income or net profit. From the net profit margin, which is the last column at the end, we are seeing that Scotiabank has a net profit margin of 36%, which is higher than everyone else. NCB is at the low end with approximately 10%. So generally, when it comes to profitability, the higher the number, is considered better. So in other words, according to this, Scotiabank is the most efficient bank at extracting net profits from its available revenues, right? So in other words, for every dollar in sales or revenue, it's earning 36 cents in net profits. Whereas on the flip side, NCB Financial Group is only able to extract 10 cents, right? So this is one way of assessing the profitability of a company using the net profit margin, right? And that's how you would interpret it. Now, in terms of practically how you would go about getting these numbers, so you just need to go on the Toronto Stock Exchange website, and they have all these listed companies with the financials. So one of the requirements of being listed on the stock exchange is that you must publish your financials. So if you want to do this exercise on your own to practice, you simply would need to go to the Toronto Stock Exchange website, and there you could find all the listed companies, and you can pull out the financials. Now, in terms of the actual financials, the inputs for this formula would be net income and revenue, right? So essentially, you just need to go to the income statement for these companies in order to pull these numbers and then calculate the net profit margin. So moving on to the second profitability ratio, right? We have the return on equity. And as mentioned before, this essentially tells us how well the company is generating profits for its shareholders, right? And the formula is net income or net profit divided by equity. Now, based on what we're seeing here, again, it looks like Scotiabank is ahead of the pack, right? So it has the highest return on equity, while in this case, First Citizens Group has the lowest return on equity. So based on the two ratios we have done so far in terms of profitability, we can at least initially assume that Scotiabank is the best in class in terms of profitability, right? It had the highest net profit margin as well as return on equity, right? But it should be noticed, however, that profitability is just one aspect of firm performance, right? We come into the other aspects, right? But just to note, at least with respect to profitability, we can say that Scotiabank is generally performing better or more efficiently at generating profits compared to peers in the banking sector, right? So in other words, how to interpret this, for every dollar that a shareholder would have put into Scotiabank, Scotiabank is able to generate 15 cents in net profit. That's how you would interpret the ratio. Moving on to the second category that we wanted to touch on is liquidity, right? And one of the more popular liquidity ratio is known as the current ratio. And this just basically tells us how well the company is able to pay off short-term debt with available current assets, right? So we said short-term debt will be any obligations that the company needs to pay within 1 year, right? So that's the denominator in the formula. That's the current liabilities or current debt. And the numerator consists of current assets. So these are assets that the firm can quickly convert to cash. So some of the more popular current assets would, of course, be cash itself, inventory, any prepaid expenses, any accounts receivable. So if, for example, you would have given customers credit and they need to pay within a one-year period, that would be considered some of your current assets. So basically, we are looking at how well the company can cover its short-term obligations with its available short-term assets, right? So for this example, we're going to use companies in the conglomerate sector. So we have Ernst McCall, Grace Kennedy, as well as Massey Holdings, right? Now, with respect to how you would go about getting these figures, the current assets and the current liabilities could be found on these companies' balance sheets. So when I would have spoken about starting out business in terms of source of funds, right? That would be the right-hand side of the balance sheet. So that's where you could find the current liabilities. And then in terms of what you use the funds for, that would be the asset side. So you can find the current assets on the left-hand side of the balance sheet. So using these numbers, we can see that McCall has a current ratio of 1.5, Grace Kennedy 1.3, and then Massey 2.5. So generally, the interpretation is that the higher the current ratio, the better because it means for every dollar in liability, you have more assets to cover it. So in the case of Massey, for every dollar in liabilities or current liabilities, they have $2.50 in current assets to cover it. So it is considered safer, right? So based on this, we can say that Massey, in terms of from a liquidity point of view, is in a better position than Grace Kennedy and Anson McCall, while Grace Kennedy is in the worst position. Now, just because what we're using companies on a comparative basis, and Grace Kennedy is the lowest, that doesn't necessarily mean that Grace Kennedy is a risky investment, right? Generally, the rule of thumb is that the current ratio should be greater than 1, right? So even though Grace Kennedy has the lowest current ratio within the industry, that doesn't necessarily mean that, Grace Kennedy would be a risky investment or a poor investment. Just relatively speaking, Massey and Anson McCall are in a better position from a liquidity point of view, right? So that is essentially the current ratio. The next category we want to move on to is the solvency ratio. And I said from before that solvency, we're really dealing with the firm's long-term debt. And specifically, the ratio that we want to touch on is the debt to equity ratio. And that is found by dividing the firm's total liabilities divided by its total equity. And again, for this particular formula, you can get the inputs from the balance sheet, right? So basically, this tells us for every dollar in equity or every dollar that a shareholder puts into the company, how much debt does the company have, right? And the example we want to use is from the trading sector on the local stock exchange. So we have Agostini, LJ Williams, and Prestige Holdings, right? So the formula again is total liabilities divided by total equity. So in other words, for every dollar that Prestige Holdings shareholders put into the company has about $1 equivalent in debt or borrowings. For LJ Williams, for every dollar that shareholders put in, there's roughly about 40 cents in borrowings, right? So generally, for this particular ratio, lower is better, right? Because debt, the higher the debt, it runs the risk that the company could go into bankruptcy, right? So debt on an unsustainable basis could really strangle a company if it gets out of control. So for this particular ratio, lower is better. And as we can see here in this example, Agostini actually doesn't have any interest-bearing debt. So that means that the funds for the company is entirely from shareholders, right? So in this case, Agostini would be considered the safest because it doesn't have any debt on its book. So we don't have to worry about, let's say, bankruptcy or a going concern for the company going forward because there's no debt that could cause any issues, right? Now, just because Prestige Holdings has the highest debt equity doesn't also necessarily mean that they are in an unsustainable position, right? It's just relatively, they have the highest within the industry, right? So just to note, but that's something you want to keep an eye on, right? It isn't conclusive on its own just to state because the company has the worst ratio within a particular industry that is generally a concern, right? But it's just something to keep an eye on or keep at the back of your mind if you're thinking about investing in that particular company, right? So that is the debt to equity ratio. And the last category that we want to touch on, valuation multiples, right? And the most popular multiple that investors look at is the price earnings ratio or the PE ratio. Now, to calculate the price earnings ratio, we need the share price of the company as well as the company's earnings per share. Now, earnings per share in itself is a calculation, but it's usually found on the income statement. And as the name suggests, earnings per share. So generally in finance, if you're not sure what something means, typically it is what it sounds like. So anytime you see the word earnings, we're talking about profit. So when they say earnings per share, it essentially means for every one share that you own, what is the portion of profit that that share entitles you to? So as I said in the beginning, once you're a shareholder or you invest in equity, you are part owner. And as a part owner, you are entitled to a portion of the profits. So earnings per share just represents that figure that you are entitled to as a shareholder for every one share you own. So the PE ratio will be the share price divided by the earnings per share. So how you would interpret that is that that number will tell you how much you are willing to pay to own that stock for every $1 of earnings that it can generate for you, right? So that's how you interpret the PE. So now we're going to use some manufacturing companies to illustrate this, how you would calculate the PE ratio as well as how you would interpret it. So here we have Angostura, Garden Media, National Flour Mills, Unilever, and Whitco, right? So we have the share prices here as well as the earnings per share, right? So typically the earnings per share on most income statements are already calculated for you, so you don't have to actually calculate it for manually, right? So when we calculate the PE ratio, so we're just dividing the price by the earnings per share, we get the numbers at the last column. So with respect to the PE ratio, generally, lower is considered better from a value point of view. So in other words, based on these numbers, Whitco is considered the most or the best in terms of value. The reason for that is that how we interpret the PE is that for every dollar in earnings, how much are you willing to pay for this particular share? So in this case, it appears that investors are willing to pay $20 for every dollar in earnings of Whitco. Whereas on the extreme for Guardian Media, it looks like for every dollar of earnings, investors are willing to pay $47. So from a value point of view, Whitco looks to be a better buy in terms of getting that $1 in earnings, right? Now, with respect to this one, it may not be that someone is looking for a bargain, right? So that's one of the beauties of investing. People have different priorities. Another way of looking at the PE ratio is that this is what people believe the company is going to perform in the future in terms of growth. So typically companies that are expected to be high growth companies like tech companies, they tend to have higher PE ratios. So it could be you want to defer getting a so-called bargain right now because you believe that this company is going to be performing or have astronomical growth in the future. So you don't mind paying a little more now to get the benefits further down the line. So it just really comes down to preference at this point. If you believe a lower PE is better, then you would be generally considered a value investor. And if you believe that a higher PE is better in the sense that it displays the growth potential of the company, then you would be considered a growth investor. Personally, I'm a value investor, so I, based on this analysis, would say Whitco is the best in terms of relative valuation, right? And that is one of the most popular market or valuation ratios, the PE ratio. So just to wrap up, in terms of final thoughts, so financial ratios are just a tool that you could use to help assess the health of a company by doing some simple calculations on some items that you would find on the income statement or the balance sheet of the respective companies, right? So we can calculate or measure a firm's liquidity or its ability to manage its short-term debt, solvency, its ability to manage its long-term debt, profitability or the returns, as well as the market value, right? And ratios, as I said before, levels the playing field. So it gives us a better understanding of a company compared to just looking at the raw financial data, right? And as I mentioned, also, it's very useful to compare companies within the same industry. And the last thing I want to say is that practice makes perfect. So you don't need to have a PhD in finance or be an investment professional to do this kind of analysis. As we just showed, it's fairly simple. And once you know where to find the numbers, once you practice like anything else, you will get better at it, right? So if there's a key takeaway that I want to leave with you is that, just start practicing. The more you do it, the better you'll get at it. And that could help you put in a better position in terms of making an informed decision of what companies you would like to invest in. Right, so that's it from me. So I'll pause there. I don't know if there's any questions or comments, and I'll hand it over to Phil.
Thank you. Thank you, Andrew. I love how you closed off there by saying, encouraging and practicing and not really needing to have a PhD. or a degree in finance. You need that if you have a career in finance, right? But certainly to do your own investing, Andrew is very correct. It's not, not as intimidating or as daunting as it seems. So thanks for breaking it down. This segment, well, I think I said at the beginning, there would be a Q&A segment. So take this opportunity to type your questions. I'm already seeing some questions. So Andrew, without blindsiding you, there's some questions in the chat that I'll pose to you. And anyone who wants to ask some questions, just take the opportunity to type it in the chat. So the first question I'm seeing here is, thanks PTG and to the presenter for simplifying these ratios. I note that you said that the ratios are based on actual financial results. Are these the most recent financial results?
So no, I don't think these are the most recent. I think they were maybe a year or two ago. So
Right.
maybe 22 or 23 from those financial years.
Okay. Yeah, that's a good question. And I think also the takeaway there, even though they're not the most recent, certainly the framework is there based on the four areas that Andrew described, which is the profitability, liquidity, solvency, and valuation multiples. I'm seeing another question. You went through the four areas, and what would you say would be the best of the lot to get a good gauge on the health of a company?
In terms of health, I would say probably solvency because it takes a more long-term view. So the profitability has to do more with returns. So not necessarily health per se. The market is whether it's a good investment from a price point of view. So if I had to say out of the four, in terms of health, I probably would go towards the solvency as the most important. But a key thing to note is that you don't want to just focus on one dimension of a company. It's best to get a more holistic view or comprehensive view. So it's best to use the different categories in tandem with each other to get a clearer picture of the overall performance and health of the company and whether or not, from a valuation point of view, is something that you want to get in. Because, for example, a company may be strong, healthy, but the price is just where it's currently worth, it may be overpriced. So it's something that you would want to keep, like, let's say, on a watch list that potentially the price comes down and maybe a good investment. But generally, you want to keep everything in tandem with each other to make an informed decision.
Okay. Thanks, Andrew. And I'm seeing a couple of people asking, would we get this recording? So I can confirm that the session is being recorded, and the CFA Society as well as PhilDigap will put you on notice in terms of how you can view this recording. But I do know that the session is being recorded, so hope that answers the questions for the time being. Are there any other? Are there any other? We still have some time. So as I said, you can type your questions in the chat. We do have a couple more minutes before we wrap up. I'm seeing a question here. How do you know if stocks are overpriced?
It's a good question. So for that particular question, you will want to look at the valuation or the multiples ratio. So the one we just did would be the PE. So in the example, we saw that Guardian Media had a PE that was higher than the rest. So what you could probably do in that case, if you're looking at it from an industry point of view, is probably just calculate the average of all the companies within the particular sector, and then look at the PE ratios and compare it to that average price. So any company with a PE ratio above the industry average will be considered overpriced or overvalued, while all the companies below that will be considered undervalued.
You. Okay. So I'm seeing I have another question. How reliable is ratio analysis in the local context, historically, has it been linked to share price performance? And if you want
So
me to
good
repeat that,
question. And this is
yeah.
something that's actually topical right now. So there are periods where the fundamentals, meaning the ratios that we calculate, it may be strong, but the share price may not necessarily mimic that or follow that trend. So, for example, Republic Bank recently would have reported uh, hefty profits, but yet the share price has been declining. So there are periods in time where the share price doesn't logically follow um, what the financials are saying or what the ratios are saying. And that has to do with some uniqueness to our local market in the sense that our local market uh, isn't the most liquid, doesn't have the most players. So we have some distortions that may not necessarily would have translated if it was a more developed market. But generally, in my opinion, if you have a long-term time horizon or a long-term view on a particular stock, uh, I believe that it would translate in the long run, based on the analysis of the financials using the ratios. So if after you do your analysis, um, you think you give this company the green light to invest in, there may be short-term periods that the share price underperforms, but I think generally in the long term, I think the performance would match the share price performance going forward.
I hope that answers the question. Seen another question here, Drew. What advice do you have for someone who wants to pursue a career in finance or investment management? It's an interesting one.
Okay. So I'll just tell you what I did. So coming out of secondary school, I was interested in finance. Around that time was the global financial crisis. So I always was seeing financial news, financial stories in the news. So that kind of piqued my interest. So what I did, I just went to investopedia.com and just started reading the different articles, reading definitions to stop watching videos. So it's even more available now in terms of social media, YouTube, etc., in terms of learning about finance. A good resource would be Khan Academy, in my opinion, where he breaks it down very simply. Uh, you can subscribe, to Fill the Gap, uh, to get
Yes,
your insights
of
as well
course you
as,
can.
building your knowledge and understanding of finance. And in terms of from a formal point of view, if you really want to learn everything there is to know about finance and investing. Of course, I'm biased as a CFA charter holder. I would suggest that you look into going to this pursuing the CFA program. You do need to have a bachelor's degree to pursue that. It doesn't have to be in finance, however. And then from a cost point of view, it's far more economical than doing, let's say, a master's, right? So that would be my advice in terms of anyone that is desirous of going into finance or pursuing a career in finance and investing.
I mean, that's great advice because it had me kind of going down memory lane as well as to how I ended up in finance and investing. And it's really, so I was around like 18 years old, 18, 19, and did not know what to study. So I left Trinidad not knowing what to study. Um, I knew it was not going to be business or marketing, and I couldn't really. I did accounting, I did economics. I was not excited about accounting, but I just didn't know. I was like, I couldn't distinguish between finance and accounting. And it's really so another piece of advice. I'm saying that to say this is really someone who was in their senior year or third year at the university that I went to that had a conversation with me about exactly, the types of careers that you can have in finance and exactly what finance is about. And that's how I found out. So it's great to get a perspective from someone, or people who are in the industry so you can look for a mentor as well. And that certainly will serve you well if you're trying to embark on and pursue a career in finance. I'm seeing, okay, so we have literally, I'm going to take two more questions because I'm seeing time is this. So I have two more questions, Andrew, any hot seat here. How can I go about investing in some of these stocks? That's one. And then there's one more, so I can ask. And I guess I should ask it one. What's the least amount that you can start investing in?
Okay, so generally to buy shares, you would need to have a brokerage account, to open a brokerage account. So in Trinidad, there's roughly 6 or 7 stockbrokers. So the requirements to open the account would be the same as opening a bank account. So proof of address, proof of income, the usual stuff that they need, 2 forms of ID. So in order for you to invest in a publicly listed company, you need to have a brokerage account as well as a TTCD account, which the broker will handle for you once you open the brokerage account, right? In terms of getting started, each broker would have the minimum requirement in terms of the amount you need to start the account with. But I think generally 5,000 will get you started in all. Film, you may be more versed in terms of what the actual requirements for in terms of the minimum investment, but I think generally at least $5,000 should get you to open an account. It may
Yeah,
be
I saw it. It varies. So no, that's right. It varies. So I did see, because the most recent post I did, the last NCB Merchant Bank, their minimum requirement is 2,500. I can't say if there's their lower minimum amounts to start, but that I think is the lowest that I have seen. Because I used to think it was 5,000 as well, but I know I've seen NCB Merchant Bank. Um, that's their minimum requirement. But it's important, I mean, just to add to what you're saying, it's important to really check out a broker and see what is useful to you. They all provide services, but some may not be as useful to you. Some may be a bit more expensive because of the type of shop that they're running. So it might have higher barriers or higher initial amount to start. So it's good to do your research on the brokers. And you can get this information on the stock exchange website, as well as I do post from time to time on how you can actually get this information. Thankfully, there are no more questions, so I didn't feel like anyone was left out. So at the beginning of the webinar, and even during the webinar, and somewhat throughout the question and answer segment, we acknowledge some of the uncertainties that you may have had when it comes to investing. Hopefully, your confidence has been boosted by the invaluable information provided by Mr. Maharaj. He shared on how to do your own simple financial health check on a company's some of the companies that you're thinking about investing in. I know it's a lot to take in a short space of time, so it's understandable if you need more information and time to consider and measure the risk that comes with investing, right? But remember, it is all about putting yourself in the best position financially to be able to achieve some of your big life goals. So if you still need some assurance to take that first step, reach out, because the CFA Society, as well as Fill the Gap, we're here to help. Additionally, the Fill the Gap team recently launched the I Invest program, which is a personal finance and investment education course to take you along your personal finance and investment journey. So we're almost at the end of our time together. So I must say a huge thank you to Mr. Andrew Maharaj of the CFA Society of Trinidad and Tobago, and of course, thank you for joining us. Please look out for the replay or information as to how to see the replay. Thank you very much for joining us. Have a wonderful day.